Alright, what's up everybody? Baller Trader here. Excited to start my video series. I've been doing the weekly forecast. They've been going pretty good. But you know, there's only I can only do so much with the weekly forecast. They kind of get old. So I'm just going to jump right into this. I don't even have a itinerary. I don't know what the next episode is going to be, but the first episode is some pretty powerful stuff that I really I really think is very good knowledge to have if you don't already have it, and we'll see how it goes. So this is the first episode, the introduction to professional Bitcoin trading. This is cool stuff, man. It means a lot to me, and we'll see how y'all like it. Um, I guess I got to do the disclaimers first off. Bitcoin is risky, and if the Chinese Communist unregulated exchange doesn't just steal your money from you, or if the Slovenian or the Bulgarian or the Russian mafia doesn't just steal your money from you because they can do that, Bitcoin is very volatile and highly leveraged, and you might lose a lot of money too. So there's a lot of risk. Even if you don't trade, there's a lot of risk because the exchanges will probably just steal your money. Anyway, that's the disclaimer. And another disclaimer is all of these concepts are going to be originated from the Inner Circle trader, Michael Huddleston. He taught me pretty much everything I know. Because basically, Charlie Munger, if you don't know who he is, he's basically Warren Buffett's right-hand man. He's a billionaire that runs Berkshire Hathaway with Warren Buffett. And he says that 99% of people aren't really worth listening to. They don't know what they're talking about. But as soon as you find that one person, you listen to everything they say. And that's what I found in the Inner Circle Trader. And so the Inner Circle Trader, he says Larry Williams was his mentor. So I go and I find all the shit about Larry Williams that I can do, even though Larry Williams teaches S&P, whatever. I'll learn it. ICT talks about Chris Laurie. I'll learn it. ICT talks about his concepts, his way of viewing the market. I learn it. So that's my philosophy. Just a shout out to ICT, credit where credit's due. I think I do put a little bit of my own flavor to it because I am the baller trader. I gotta have flavor. But let's just get right into this, man. So these are the three tenets that I like to think of. The markets are very abundant. Success in the markets is mainly psychological, and a consistent and repeatable plan is absolutely necessary to your success. So this is basically what the video is going to be about. It's just going to be about these three core tenets as the introductory episode. So abundance in the marketplace. The average monthly range in Bitcoin is 36%, and that's pretty ballin'. And we're going to actually look at, and we're going to actually get out of here, and now we're going to look at some shit that I made. I got this from Quandl.com, Quandl. You can download data. What I did is I calculated the daily range for every day from January 1st, 2014 to the present day of March 23rd. And what we do from there is we calculate the average daily range for every single month, and we just see what the volatility is doing. And it gives you kind of some interesting things you can do with like where your stop loss should be, but those are different episodes. For now, what we're looking at, it's not clear, but we're looking at this line. This is the average monthly range. And you see I said in the slide, I said the average monthly range is 36%. Well, you can do a lot. There's a lot of room to work with for 36%. You can pull a lot of money out of the market if you're dealing with the 36% range. So you see in January it was 27% for the month. In February it's 52%, yada yada yada. So let's go to this chart or this spreadsheet, and let's play out this hypothetical scenario where you have $5,000 in equity. Now these are your arbitrary numbers, okay? So these are already set. You can play with these numbers. Let's say we have a modest goal of 10%. Let's say we want to risk 2% per trade, so it's stress-free trading, very low risk, very forgiving. And let's say we want a $10 stop loss. This isn't very clear, but this is the arbitrary number that you set. So you could set a $5 stop loss, you could set a $10 stop loss. What this cell is going to say is that if we have a $10 stop loss and we're risking 2% of 5,000, which is 100, that means that our 10 coins, once we lose $10 per coin, 10 times 10 is 100, we'll be forced to take that loss of $100. Likewise, if we had a $5 stop loss, we could afford 20 coins because our stop loss is $5. We can only lose $5 per coin. 5 times 20 is $100. But we're just using very modest numbers just to show the abundance of Bitcoin. 10% per month, 2%, very low risk with the $10 stop loss, pretty forgiving stop loss. And we see that in order with these parameters set, which are very, very realistic parameters. I mean, I'll be damned if anyone is using 2% risk. I mean, I'll be damned if anyone is doing 10% risk. Most of the people are going all in, 100% risk. So 2% risk, we only need to make $50 per month in order to make our 10% goal. That's $500. If we can just capture one trade a month for $50 per coin, we achieve our goal. And if we can do that fairly not difficult task for a year, our equity will be 14,000 and we will be harvesting about $1,500 per month out of the market. And that is, if you want to be like really grinding and scrapping month to month, that's a livable wage, After taxes, maybe that's $1,000. You live with a bunch of roommates, you eat cheaply. That's a livable wage after 1 year of just starting with $5,000. Not to mention after 2 years, you're making $4,500, and it's all stemming from these very easy goals, only looking for $50 per month. So this is just fucking abundant. Every morning you should just wake up and scratch your nuts and be like, damn, the market is abundant as fuck. I mean, let's just go into the market and let's just see what's going on here. Well, here's for this month of January. Here's $272. Do you think that you could have pulled $50 out of this move if you were anticipating it? Do you think you could have pulled $10, $20 out of this retracement? Do you think you could have pulled $10 or $20 or $30 out of this move down? You see, it's not too hard to find $50 per coin per month in the charts. Let's go back to February, negative $433. Do you think that you could have sold at any time and made $50 per coin? You think you could have bought this exuberant sell-off for, what is this? This is 400 to 600. This is $200 in 2 days. Do you think you could have found a way to buy and make $50 per coin right there? And that's just one trade in a month. What about here? This is a $100 candle in 1 day. What about this whole sell-off for the month of March? Do you think when price went from 717 down to 473, do you think you could have seen something to get $50 per coin out of this month? Remember, $50 per coin, you're risking $2 per trade. There's no stress in losing $2 or 2% per trade. If you do lose 2% per trade, what does that mean? That means your monthly goal shifts to 12% because now you're starting at a 2% deficit. So now your monthly goal is 12%. So your monthly goal just went up $10 per coin. Your weekly goal is 15, right? So let's see the difference here. 10%, that's 12.5. Say you lose a trade, now you just need to make $2.5 per coin extra per week. So even if you miss a trade, you're only set back a couple dollars per coin for your target for the month. And so it's a very forgiving strategy. not to mention that when you are trading with this mindset of abundance, you're only looking for the best trades. You're not looking to spend all day in front of the charts. You're just looking for the highest probability trades, and you're looking to make 20, 30, 40, $50 per coin, knowing that a couple setups per month are going to comfortably get you $50 per month on a coin. And that's basically some of the most powerful knowledge you can have. I mean, you don't need to be staring at a 5-minute chart going 20x all-in margin so that you can make $3 per coin, and then you need the 20x margin, so you need ridiculous stress and leverage and risk just to pull a decent gain out of the market. That's not a professional approach to the markets. So let's see what else we're talking about. Markets are abundant, success in the markets, right? So we need rules, because the market is basically an orderless, never-ending roller coaster that could go into an infinite number of directions at any given time. There is no order until you define the rules that you play the game by. One thing you need to do is define your lot size, and so let's go back into that. This is your lot. The number of coins is your lot. It's kind of like in Forex. In Forex, one lot is $100,000 of currency. But you don't place an order in Forex by typing in, I want to buy $100,000. You type in an order in Forex by typing, I want to buy one lot, or I want to buy 0.1 lots. So in the same sense, you need to start to define your approach to the market by looking at your order sizes in lots. So this is going to make it a very uniform approach to the market. And so in this example, one lot for us is 10 coins with these parameters. That means that we just know that with one lot, all we need is $50 per month, and we are golden. We are basically professional Bitcoin traders. Going back, so this is pretty key right here. If you don't develop the skill of sticking to a routine, how are you going to hold on to your money? So this looks kind of boring, right? Even though it is exciting, and it is kind of meticulous, and it is a routine. If you don't develop the skill of building this routine, like we said, the market is an orderless, never-ending roller coaster. It could go any way, at any time. It could do anything. So you must have rules. If you can't follow rules, you're just up against an unknowable amount of variables and data that you just cannot. You just have to define what you're looking at, because the market is just infinite. So you need to strip away some of the information and only focus on some stuff. Now, so what does that mean if you don't develop? Okay, so basically let's run through an example of you have like one coin, you get hot, you turn it into 10,000. Is $10,000 enough? Probably not, because you could just 20x margin that 10,000 and make 50,000. Is 60,000 enough now? Well, let's say you withdraw 20,000 to pay for some things. Now you only have 40,000. Well, now you're in a bad habit, right? Now you could easily just make that 20,000 back in one trade. And let's say you do. Let's say you make 20,000 back. Now you're at 60,000 and everything's good. But you're just in a very destructive habit, because you don't have a plan. You don't have rules, and you don't have any discipline in your trading. And with one trade, you could very quickly just totally screw yourself. So that's an important point. While this is very meticulous approach, it's necessary, because the markets are so overwhelming. You need rules. You need to control risk. You need to define what a lot size is. You need to know what you're trading, and you need to know what you're trying to make every month. And you need to know or have a plan on how to get there. So I'm just gonna see what else we're doing here. I think one thing that's exciting about this strategy is what's your plan? You need rules. We're talking about you need rules. I think there's one universal thing that all traders can agree on. It's that we would like to know to sell here, and we would like to know to buy here, right? It's basically as simple as buy low, sell high. As cliche as that sounds, it's very powerful information to know to buy or to sell up here and to buy down here. If you could just know that this was a top in advance, you would have, this is like $1,000 to $700, this is $225 in a couple of days. This is just insane amount of money. So if you can develop rules that help you find the top and the bottom, you are at a huge advantage. A side effect of this type of way of looking at the market is that, let's say we anticipate this being a top, and we anticipate, we could reach for these lows. So our trades are going to be short bias, right? We're going to be a bear bias. We can't really mess up. We're not looking to buy because we kind of anticipate the high and the low because we're operating on higher time frame analysis. Likewise here, if we can anticipate a high here, there's basically no mistake that we can make in this entire month because we're not buying, right? Because if this is a high, we're not really looking to buy. Especially since we have an abundant view of the market, we know that we only need a couple trades per month to really make a living. So, yeah, we're not looking to buy. And how could you mess this up if you're not looking to buy and only looking to sell? All these candles are red, right? There's a very few up candles, but that's just kind of a logical retracement, and then it's just all down. So that's the power of having rules and just kind of developing a way of looking at the market. Now, psychology, why do you deserve to win? What differentiates you from the 90% of traders that lose money? It's all about psychology. Really, what does differentiate you from 90% of traders that lose money? If you are trading on a system that can be learned by a 5-minute YouTube video that everyone else is doing, if an indicator is diverging from price on a 15-minute chart, what really differentiates you? What are you doing to differentiate you from the 90% of traders that lose money? I would say that most people that follow that strategy do lose money. So you have to develop your psychology. You have to figure out what you're going to do different than every other trader that's going to result in you finding these moves and profiting off them. So what I mean by that, or let's take it a bit further, psychology. You need to know what type of trader you are. Because in this 1 month, one trader might be able to say, okay, this is my setup. I see this support, I see this resistance, I'm going to sell. And do you think he could make $50 here off this trade? Okay, he probably did. Another trader, his psychology is different. He's going to see this down move, and then he's going to see maybe a low form here. He could make $50 on this retracement. And then still another trader is going to be like, well, I missed this, but I see we broke down here in this retracement into this order block, into resistance. I could sell here. Do you think he made $50? Probably. And then another trader probably just missed everything, but then he saw a break in market structure right here and said, okay, that's a huge break in market structure. I didn't even trade this month, but I got a good signal here. I can sell at resistance up here. Do you think he made $50, $100, $150? I mean, the price dropped $430 this month. He probably did all right, even though he didn't even trade this month. And that's all you need to build equity at an astounding rate. And that's what we're talking about here. It's not about the money. It's about figuring out which trader are you. Are you the trader that sells here? Are you the trader that buys here or sells here or sells here? Everyone's going to view the market differently. but there's an abundant amount of opportunities to make $50 per coin in a month. And you could, that's not to say that you can only sell here, because you could also do the retracement. You could also, sell some here and then just hold it and see where let it rides, right? See where it ends up. But in the end, in the beginning, it's not about the money. It's about determining where you feel comfortable in looking for these big moves, because they're everywhere. You could buy, you could sell, you could short, you could long, you could hold for a couple days, you could hold for a month, you could miss a whole month's worth of trading. But it all depends on how you view the market. It all depends on your rules that you've created right here. You've set your rules, and it all depends on your psychology as to where you're going to find your opportunities. Moving on, your trading plan, you need to write it down and stick to it. So we've already covered kind of the trading plan. What is your trading plan? Are you going to be shorting here? Are you going to be longing here? What's going to be the criteria that you have to see in order to prompt you into taking a trade? And it has to be consistent. And if you're trading off of a RSI, one trade, and then another trade, you're on a 1 hour chart with 5 diagonal lines, and you're taking another trade because the diagonal lines are telling you something, and then you're doing a Fibonacci spiral on like a 4 hour chart the next trade, and then you're doing a CCI with a MACD histogram divergence on another trade, you don't have a plan, and you're not going to have any consistency. And that's why you need a trading plan, and you need to stick to it. The power of having a trading plan is that you can track your results. So I read a book a while ago it was called Why We Make Mistakes. And it was basically saying that weathermen are pretty accurate at predicting the weather because they get constant feedback. And it's this constant feedback that actually makes us better at adapting. You've probably heard the old adage, if you can measure it, you can improve it. And that's why you need to track your results. And that's also why you need to write down your trading plan and have a consistent plan of action every time. Because if you don't have a consistent plan of action, how can you even know if what you're doing, how can you even track anything or know if what you're doing works? And how we track results is we use our spreadsheets. You log your trades through the Google spreadsheets or Excel. You say entry price, exit price, and you can plot your equity every trade, and that just keeps you honest, and you can see if what you're doing is working. If what you're doing is not working, then you know that you're getting feedback and you can improve, right? If what you're doing is working, you can continue to further develop that strategy. You can also have a trading journal where you measure a bunch of different things about each trade. You can write thoughts about trades. You can ask questions. You can record how you're feeling the day that you took the trade. And it also serves as a feedback mechanism, because once you write it down, it's there forever. You can go back in a month and see, what was I thinking back then? Do I still think like that? And does that thinking serve me? Or have I grown? Or have I changed for the worse? As opposed to like a month ago when I made this journal entry. And that's basically it. I thought I was going to take a long time. I probably spoke too quick, but it's just because I didn't want to make this too long. Pretty basic stuff, but it's definitely powerful stuff. And yeah, that is basically it. I feel like I'm forgetting something, but there's going to be more. I'm going to do more video series too. I want to do one called the Matrix Sessions, which is just me talking about some philosophy type stuff as it pertains to trading. But did I forget anything? Did I forget anything? Here's one cool thing. There's kind of a trend for the first quarter of every month to be more volatile. You see April is the start of quarter 2, 8%. January is the start of quarter 1, 10%. January start of quarter 1. That kind of disproves the theory. February was more volatile than January. July, this kind of disproves the theory, but this was a very not volatile quarter. And then October is the start of quarter 4, which was the most volatile month of that quarter. So what we're coming up on is April, and I'm expecting some volatility in April since it is the start of quarter 2. And, you know, that's some cool stuff. And it's just, analysis. I just stare at numbers and shit and see what I can figure out. So we'll see how that happens. Sample size is probably too small, but I think I'm done talking. That's just the number 1 installment, and plenty more stuff to come. Some way better stuff. Just go to my website and subscribe to my YouTube channel. And yeah, good luck, good trading.